Good afternoon and welcome to the Future of Finance. Today we will discuss how custodians have the power to make security tokenisation happen. I shall now pass you over to Dominic Hobson and the panel. Thank you.
Hello everybody and welcome to our webinar, Custodians Have the Power to Make Security Tokenisation Happen. I'm Dominic Hobson, co-founder of Future of Finance, and I'm delighted to moderate our discussion today. Now, blockchain technology has a habit of turning worlds upside down, and the financial markets are no different. Institutions are already investing in cryptocurrency, and as we shall discover more shortly, custodians are responding with new services. Cryptocurrency might just be the precursor to something similar happening in the securities markets. In that case, the spark that sets the token economy ablaze might come not from the front office for once, but from the back. Why do I say that? I say it because when transactions settle instantly, it's more important than ever to get them right. When ownership of an asset is synonymous with its private keys, finding somebody to keep them safe is a matter of intense interest. And when asset servicing is performed by smart contracts, it's absolutely crucial that somebody is making sure entitlements are claimed. Safe custody, in short, is the ingredient that could release a flood of institutional money into the token markets. But I hear you say, I thought tokens were all about disintermediation, getting rid of middlemen like custodian banks and central securities depositories and others. And indeed, tokenization might well have that effect if intermediaries do nothing and change nothing. Now, to help us assess which intermediaries are at risk if they fail to change and what the new opportunities for them are, I'm joined by 5 people who are operating at the frontier where the future is being decided. Stephen Richardson is a Vice President and Head of Product Strategy and Business Solutions at Fireblocks, provider of an institutional-grade safe custody and settlement platform for digital assets. Richard Crook is a Director at Lab 577, a software company dedicated to using emerging technologies to cut costs, increase efficiency, and improve the customer experience at existing financial institutions. Yakeen Prabdial is a Managing Director of Fifth Nine, a consulting business whose stated mission is to use digital technology to drive business disruption in telecommunications, IT, aerospace, as well as fintech by turning ideas that people have into reality. Maxime de Guillebon is CEO at Zodia, an institutional-grade custody service for cryptocurrencies designed to enable institutions to invest safely in said cryptocurrencies. Graeme Moore is Head of Tokenisation at Polymath, whose technology enables users to create, issue, and manage tokens on blockchains, including regulated security tokens on an institutional-grade blockchain the firm has built. As always, in addition to our panelists, we have you, our audience. We want your questions, we want your comments. Do send them, keep sending them using the Q&A functionality at the bottom of the Zoom screen. We won't be saving them up to the end, but we'll answer them as we go along, so you can be part of this conversation right from the start. And we're going to be very disappointed if you don't take that opportunity more than once. I'd like to begin by asking our panelists whether security tokens are, in a way, overhyped relative to cryptocurrencies. If we set aside the various proofs of concept and pilot schemes in which issuers have issued security tokens largely to themselves, there doesn't seem to be much going on. One website I look at, securities.io, records just 29 token listings in the world, of which only 12 have actually raised funds. If we look back a year, Fidelity ran a survey of 800 institutional investors and found 36% of them were investing already in digital assets, and 80% found something appealing about digital assets. So very clearly, even then, a year ago, institutions were investing in cryptocurrency, and that has accelerated over the last 12 months. A year on, they don't seem as fully engaged with security tokens. We hear a lot about how privately managed assets are bursting to be tokenized, but we're not yet seeing the issues. In other words, security tokens are not exactly a booming market, and beyond the institutions, which are usually the pioneers in these areas, hedge funds, VCs, family offices, high net worth individuals, and a handful of asset managers and corporates, it's not as if even the cryptocurrency markets are yet fully institutionalized, shall we say. So I'd like to ask Stephen and Maxime first, both are invested in this area. What is the business case for a traditional custodian to invest in providing full-blown operational support to investors in cryptocurrencies and security tokens? Stephen, perhaps you could take that first, then Maxime could give us some thoughts as well.
Yeah, I mean, I think from my perspective, if you think about securities tokens today, there's a lot of, or a lot of securities in general, there's a lot of infrastructure that's required to support that. You have central securities depositories, you have CCPs, you have a number of different organizations that are required that I don't think have yet gotten on board with tokenization of securities as a whole. They're exploring it, they're evaluating it, but yet they haven't yet connected the infrastructure as exists. I think for a custodian in the digital asset space, I think you want to be ready when the opportunity comes to engage and tie in the infrastructure, be a part of the infrastructure connectivity to do so. We've seen digital assets have enabled disintermediation in terms of where the fragmented liquidity exists, right? And there's an opportunity to think about new models of working with securities tokens and the ability for a custodian that might exist outside of that ecosystem to then tie into these potentially centralized infrastructure pieces or develop them amongst themselves has to be a pretty unique and interesting opportunity, right? So the idea that Maxime at Zodia could build infrastructure that then ties and enables disintermediated clearing directly between a subset of custodians on their own, requires that basically he is building infrastructure in the current to be able to be ready for that when the time and place does come, and as he sees more institutional demand. So I don't think that it's something where we shouldn't be paying attention, and custodians shouldn't be paying attention. Rather, they should be getting ready for that opportunity and then encouraging that level of innovation in the space.
Mm-hmm. Maxime, what's your take? I was very interested that Stephen raised the question of central counterparties there. I read a paper only yesterday that suggested that central counterparties might have a very useful role to play in fully realized tokenized economies, but that's another issue. What's your answer, Maxime, to my question about why are custodian banks investing in Zodia, for example? What was the logic? Client demand, expecting exponential growth, etc. What was the strategy?
So it always starts with client demand, right? I think that's the number one. And I think if you really think about where we are now, if you look at the flows and you highlighted them, yourself earlier on, crypto is probably right now the only real use case with liquidity, with a lot of participants for digital assets. So I think it's absolutely natural that you see a lot more, I would say, investment put into crypto assets and the technology, the infrastructure, the standards behind it, than you would potentially see behind securities token, because I don't think clients are necessarily pushing for securities token as much as banks are trying to emulate the securities token market by recreating the infrastructure. I think securities token might probably going to be issuer first or bank first, as opposed to having client demand compared to cryptocurrencies, who clearly are led by, I would say, crypto funds 3 years ago. And now we're seeing banks, we're seeing asset managers, traditional issuers getting into that space. So I think the cryptos are going mainstream, which is why you have a need for investment. Securities token, I can tell you that every bank on the planet is looking at how to approach it and what exactly, how they should really look at securities token, private chain, public chains, what's the right infrastructure, the right amount of participants. But I don't think it's as clear as it is for cryptocurrencies today. So really, client demand is, to me, is the big driver behind investment and behind the adoption of various type of digital assets.
Yeah, no, I'll jump in there. So one of the earliest questions was, are security tokens overhyped? I would definitely say no, personally. I'm slightly biased, but based on what I've been seeing, I would definitely not say that security tokens are overhyped. I think we just have to look at how nascent and early the space still is. Security tokens were really started being largely theorized in early 2017. We saw the first ones get created, Blockchain Capital, and a few others. Polymath created the first platform where any non-technical user could actually create a security token on a blockchain by clicking buttons on a screen. And that launched in early 2018. So we're in year 3 right now of people being able to create security tokens quite easily. Imagine if we were having the conversation about, is Bitcoin overhyped in 2012? A lot of people would probably say, yeah, no one's really using Bitcoin. There's not a lot of institutional support for Bitcoin. It's hard to buy, it's hard to sell, it's hard to store yourself. So, we're seeing a ton of interest out of pretty much every single large financial institution you could think of on the planet. But yeah, as Maxime mentioned, when you talk about being client driven for a lot of these folks, everyone wants to get their hands on Dogecoin when Elon Musk is tweeting about it. Not everyone really yet understands the benefits that you can get with security tokens, and how that can create a lot of efficiencies, especially inside a lot of these banks, and how it can make their back offices specifically more efficient. So it's a bit of a harder sell in terms of talking to a general person saying why security tokens are great, whereas these cryptocurrency things, they can go up 1,000% in a day or in a week. So the education is coming. But it's just that, a little slower than I'm sure we would all like, but it is coming very soon.
Yeah, just to
Richard, go ahead. I was going to ask really about you, but I'm sure you're going to say some other things. But I was going to ask you about the types of investors we're seeing. Maxime mentioned a few. Are we still at the hedge fund, VC, family office stage, or are we seeing a flood of big institutions coming into the market? But sorry, go ahead and make your point.
No. The point here is that we're seeing a natural progression. We've been experimenting with private currencies, the Bitcoins, the Dogecoins, and we've been creating and experimenting different ways of doing price discovery with those private currencies. And it's a great debate around: do we keep these private currencies, or do we move back to public currencies that are created by sovereign states, central bank digital currencies? But it's a natural progression, as Graeme's pointing out, to go from, okay, we've proved the market with private currencies, to move to securities. And whether it be equity or debt, by the market, we're seeing a tremendous amount of supply side deals coming through, mostly in the kind of fixed asset space, real estate, transport, things that you can, tangible fixed assets that you can touch and feel, because there's a third party ledger that will give you control of understanding where that asset is and who owns it at any point in time. Where you are seeing interest is very much in the private markets, where we've already had the investment in the public markets. They're functioning very well, but the private market remains opaque, illiquid, and the ability to see deal flow in the private markets is really what's driving it. So in terms of investors, Dominic, the real flood in here is private markets, be it equities or debt, is what we're seeing as an emergence of pieces.
Now, Yakeen, I'm glad that Richard brought up the question of privately managed assets, because I've been looking at the McKinsey survey of the privately managed asset market on a global scale. They put a number on it in last year. It was 7.5 trillion. And you are seeing this shift away, if you like, from public markets, a lot of delistings, a lot of companies being taken private. So there's lots of equity and lots of debt, as well as that real estate, those physical assets that Richard referred to there. But the issues still don't seem to be, irrespective of what Richard has been and Graeme have been saying, I'm still not seeing these markets really at the point of taking off on a substantial scale yet. I'm talking of security tokens here. Am I just being impatient?
You are being impatient, Dominic.
Uh-huh.
You've got, if you look at it, a very highly regulated market in the security space. Anyone can create a currency, much more difficult to get people to use it. But actually, when you start talking about equities and debt, what the Americans would call securities, actually, that is a highly regulated market. And actually, we spent the last 40 years centralizing that underpinned by the database technology. We've got a spark of innovation here with blockchain that gives us the ability to decentralize, and the regulators are now moving. So we've seen Hong Kong, Singapore, Switzerland, Germany recently, and the EU coming down the line, all starting to realize that they've over-centralized and now need to decentralize. And yes, it is about patience.
Mm-hmm. Yakeen, you're on mute.
I think the alternative trading system is something that I'm fascinated with. So I'll start off by talking about the SEC's registered new toy. And there's a bunch of tokenized hedge funds that are now appearing as security tokens on the system. Protos, I think, was one of the ones that I picked up. And it's interesting that you asked the question about hedge funds and family businesses all moving towards this security token model. There seems to be a shift. Now, whether that shift is driven by the movement from private finance to sovereign coins, or whether it's simply a natural evolution of DeFi. And that's the question that I have is security tokens actually going to drive the uptake of DeFi? For me, that is a more important question than whether security tokens are going to regulate the market, because we all need new financial instruments.
Yeah, I think that's a really interesting point. My answer would be yes. We're seeing a ton of these lending platforms, all these yield farming protocols. When people want to borrow and people want to earn interest and lend, you need hard assets at the bottom of that to act as collateral. And so MakerDAO recently expressed that they want real estate in tokenized form so that they can underpin their system, because they started with ETH, then they went multi-collateral with things like that and other cryptocurrencies. So I think that's the logical progression of what happens. And so, yeah, how do regulators feel about a financial security sitting in this MakerDAO smart contract thing that's acting as collateral, so people can have a stable coin that's determined based on how much collateral is underpinning it? And so, yeah, I think there's a lot of question marks there. But that's what we could see. MakerDAO could just say, screw it, we're going to do it. And there's going to be a security sitting in MakerDAO. And then a regulator has to decide, how do we feel about this? And then, of course, not all regulators think the same. So some might say it's okay, some might say it's not. But I do think that that's what we're going to start seeing very shortly is regulators being forced to make decisions by these decentralized protocols, doing things that maybe are in a gray area, but just places where there are question marks. Regulators are going to have to move very quickly.
I mean, I think there's a view about how do you do that, right? In my mind, right? So, and I'll say, like, do I think that it's going to be a decentralized protocol that's fully open to the public? That is the first transitional step. I actually think probably not. I actually think if you think about what Aave Pro just recently announced and what other folks are announcing around KYC DeFi pools, right? That actually, to me, seems like a very interesting first step, right? So imagine the idea that you could tokenize an underlying security, again, as you mentioned, utilize that as collateral to be able to lend and borrow, but that opens it up to different funds and asset managers that have these alternative assets to think about tokenizing them as a basis of getting into other markets that they generally want to utilize without necessarily going to cash, but utilizing cash equivalents or other alternative assets, right? I think if you for example, here in Singapore, MAS is very open to at least understanding what is the basis and the evolution of where folks think these markets are going to go, right? And I think they've shown, or regulators are starting to show, a little bit of a willingness with accredited investors and folks that can pass some level of muster, right, where the retail investor themselves is not impacted as much, to allow some level of innovation to occur, right? And so I think folks are trying, we know of folks and are seeing folks actively looking at these intermediary steps to really, drive innovation in the space, but then, I think can then be more broadly adopted overall. So, I don't see that, I don't disagree with the point around DeFi being a strong use case for these securities tokens. What I don't think is going to happen is it's going to be openly public. I think it's going to start in this intermediate step and then start to transition, in my personal opinion.
Actually, could I just get you to chip in on this, because Yakeen has taken us straight into the DeFi area where these interesting experiments are taking place. We're not just using real estate as collateral; they've been using for some time now the cryptocurrencies themselves as forms of collateral. So they are developing, I suppose, banking markets which don't necessitate the involvement of banks. Do you detect any interest among the sort of clients you're servicing now on the institutional side in understanding what's going on in DeFi markets? Are you feeling pressure to extend your service into that area or not?
Interestingly, absolutely not. No, I should probably qualify that. Obviously, as a subsidiary of Standard Chartered and Northern Trust, we target a very sort of institutional set of players. And if anything, what we're witnessing right now is actually, and this may not please everyone, but is to see the crypto market trying to get closer to the traditional finance market, be it in terms of products. When you look at the launch of, ETF, ETP, ETN type structured product, which, guess what, they get listed on traditional exchange, they get distributed through traditional means. when you look at the type of participant, I mean, we mentioned CCPs earlier. There's a great need to look at counterparty risk and management of counterparty risk, the management of collateral for digital assets. So for what we see is actually taking more of the crypto assets towards traditional finance, and that's the trend we're seeing as opposed to the other way around. And I think what's very interesting is, although we don't offer securities token custody, we do see that the infrastructure that you need for crypto assets with the same participants, the infrastructure, the payment mechanism, because I think securities tokens have a value if you start to fractionalize or make more liquid to traditional asset, but you need a way to pay in a much seamless way than what we can see today. You realize that the crypto infrastructure is actually going to be extremely useful for securities token, because it does have some of the participants, some of the mechanisms, some of the standards as well, like take the travel rule to assess and to cross custodian or peer-to-peer KYC that are fundamentally required by the regulator, by the banks, by the participants to identify all of the participants, all of the individual investors, and the accredited investor for securities as well. I think the big challenge for securities token is the regulation that is around the fact that it's securities and all of the restrictions around it. And I do think the two words will ultimately collide.
Can I ask you just a very quick question, Maxime? You've raised the question of KYC, AML, sanctions screening, CFT. Do you see digital identities solving that problem in the medium to long term?
I would love that. I would love that. To be fair, the reason why everybody's striving with private chain for securities token is because that's a much easier way to manage identity. But that's not necessarily taking the full advantage of a decentralized blockchain. So I'm not too sure what would the digital identity look like. I don't know whether it's a travel rule mechanism. I don't know whether it's going to be embedded in smart contract, and maybe Graeme can shed some light on whether this is something he's seeing in the industry. But it is going to be fundamental to enable more DeFi and also embedding this with the regulatory surrounding securities token in general.
Mm-hmm. Yeah, I'll jump in there in terms of how we're looking at that at Polymath. So we announced about 2 years ago that we would start building a blockchain specifically for security tokens. We're in an incentivized testnet phase right now, hoping to go live later this year, hopefully Q3, if things stay on track. And in terms of how we've tackled this is we've built a permissioned but public chain. So anyone can run a light node. You can see what's actually going on the blockchain. But if you want to interact with the chain in any way, so if you want an account, if you want to hold security tokens, if you want to trade assets, you must go through a KYC process. And so every single user on Polymesh has actually gone through KYC. So as we've been talking to large financial institutions over the last 3 years, we kept hearing that over and over again. Maxime's actually right, absolutely right. It's just, they said, we can't use Ethereum, we can't use Bitcoin. We're just completely unsure of who this 0x123 person is. And so having all the users go through a KYC process, we found that gives them a lot of comfort in terms of them being able to experiment with these chains.
We've had a question starting to come in now. The first one is, what are the main technological issues behind blockchain, e.g. consensus mechanisms? And we've gone from proof of work to proof of stake, and there's proof of something else now, to slip my mind, but that is evolving. But this is about, our webinar today is about custody. And so I suppose we should try and focus that on how the differences there are between keeping conventional securities in custody and keeping private keys to digital assets. Is a very different skill and technological capability, is it not? And maybe there's a huge conceptual leap which traditional organizations have to make. But maybe Graeme, maybe you have some observations on this, and I'm sure Stephen will as well, in response to our question here. What are the technological issues? There's a very broad question being asked, but perhaps you could focus on the custody component of it.
Yeah, tons. It's still very early building on these new things called blockchains. And so there's always an interesting thing that happens with new technology coming about, which is everyone wants them to do the old things just as fast and just as well, but 100x better. And sometimes they don't, because usually they do something new. But in terms of how they do the old things, they do them very poorly. So one example would be, transaction settlement. So on a blockchain, Bitcoin is whatever, 7 transactions a second or something. Ethereum's a little bit better, and then you have some of these other blockchains that are amazing, but then the knock against them is that they're incredibly centralized. So kind of almost what's the point of having a blockchain if it's completely centralized? So I think the main technological issues that are let's say plaguing the industry, or that a lot of institutions find challenging, is just that it's new. They've been using their same systems for 20, 30, 50 years now, maybe even longer in some cases. And the incentives to switch has to be so large for them that it has to be an absolute no-brainer. And so we're starting to see these institutions play around. We're starting to see a lot of POCs. We're starting to see a bit of innovation going on inside these large behemoths. But ultimately, it's just that these things are new. I would think is the main technological challenge in terms of custody for them, is they have to wrap their head around every single edge case that can potentially happen. And when you talk to these folks, it's just you don't see the world the same way they do. You're so excited about this new innovation, and you're saying, look at all the great, amazing things they can do. But then they have their compliance officer come in, and just the endless amount of questions that they have and use cases that you weren't even considering at all is what I find very fascinating. So in my opinion, that's the main issue, is just getting these large companies that have done the same things the same way for many, many years to migrate their processes to something that they understand is more efficient. You can be more automated, you can be more transparent. They understand the benefits, but it's just all of the millions of edge cases that they need to work through, and especially in a regulated market, those can be very, very consuming.
Graeme, you said, yes. Sorry, Richard, go ahead.
Let's jump in there. So I think Graeme's making a really good point, and it does show the context we've got here. You're seeing everyone recognize that the rule book's not going to change. So it may gradually, but they're not going to throw away years and years of accumulated regulation that were put in for good reason. So those that are coming in from a crypto space who think that the rule book's going to change to meet their abilities of their technology is always a waste of time. You see that someone like Polymath has worked hard to add AML CTF to make sure they meet the fin crime. It's exactly the same as we found when we put the requirements in to Corda back in 2015, is build a blockchain that will be finance grade. You can't get out there and have a blockchain that has got full transparency, because it gives a lot of the commercial use cases no ability to operate. Rise above that, you cannot be on a financial system and be anonymous. It's just not acceptable when you've got the fin crime and the Patriot Act all over the place. So you will see gradually these technologies beg and borrow from each other, but they will all end up conforming to the same requirements. As Graeme says, as you walk into these financial institutions with your new inspirational technologies, what you actually discover is it isn't the compliance officer saying no. They're quite comfortable with it. You just have to meet the regs. You do find, actually, as always, a social problem that, as Graeme's alluding to, that people have done it this way. And then if you look inside most of the banks, and we usually use the fact that the average age of a payments clerk in any bank is somewhere near 55, which means none of them have ever seen ticker tape as a payments. They've only ever seen SWIFT from the day they walked into the bank. And the idea that they're going to move from SWIFT to something else isn't a technical discovery or regulatory discovery. It's a social one. They can't comprehend making a payment without using SWIFT. So there are some big leaps here. It isn't just regulatory, it is social as well. But we're getting there. The technology is, and to the question that was asked, the technology takes time. It took us a long time with the internet to learn how to make credit cards secure. That took us a while. It will be the same with blockchain. We're only, as Graeme says, 3 years in to a long journey.
Purely from a custody standpoint, though, I would disagree a little bit. There's three things that are fundamentally missing right now, which is a massive issue, especially as you go to payments obligation and settlements. One is the lack of payment finality, right? Which is a reality, and that is a massive issue when you talk about settlement, because the two don't necessarily match with one another. The second one is the concept of closing a relationship, or closing an account, or closing a wallet, right? When you have a presence on chain, you have it forever. Your private key is always valid. Your wallet is always there, and a lot of our clients don't really understand that they can't close an account and move to a different provider, or it's not like you carry your keys around. And the third one I said is identity, because again, these are problems related to the chains that people either need to get used to, or the regulation needs to adapt. But these are generally issues when you try to marry these technology with the requirements and the regulated activity or payments activity, etc. And these are fairly genuine. And I will leave the ESG side of the question. I will leave it on the side, because that's obviously a topic that is starting to emerge as well, but not necessarily fundamental for today's discussion.
Mm-hmm. So there are plenty of contradictions still exist. Richard, and I heard what you said about, and I've heard you say before about convergence, and it takes time, and there are social barriers as well as technological and procedural ones. But this contradiction is maintained. It is very different to custody a security token, to keeping securities in multiple ledgers and reconciling them with all the various parties involved. There is a contradiction between the closed systems of the existing world with their Swift messages and their BIC codes and their IBAN numbers and all the rest of it, and identifying things through the generation of random numbers. So I can see that this is going to take a very long time to arrive at some coalescence, I suppose, between the old world and the new.
It's not that long ago that public securities were decentralized and all the brokers used to hold the certificates, and there used to be a long period of settlement. Over the last 30 years, we've spent a lot of money centralizing that infrastructure in things like CSDs under the exchanges. And in actual fact, we've written the regulation, which means that they are gifted a regulatory moat, and therefore they've got pricing power, and in many jurisdictions a monopolistic power. So actually, it's not that long ago that we were decentralized. The regulators understand that we have swung that pendulum too hard, and we're now pushing it back. The technologies, many of the technologies don't meet the requirements at the moment, but some were designed specifically to meet the requirements. And in terms of things like wallets and keys, which take the holder all the way down to the beneficiary, the investor, the end investor, we wouldn't see that model being adopted in many places. You'll find that there'll be a hybrid model, just as Stephen suggests, where we'll see an evolution, just as the internet technologies were taken in-house by the banks, used internally, and then when they were ready, they opened up the firewalls, and that was hard work, opening up the firewalls, so hard that the word firewall is still used in common English. So, these things take time, and I think if you look at the securities, the dematerialization of that private securities market will probably not go the same way as the public one went, where we centralized it into large electronic databases, but we will look to try and decentralize it so that we can actually get a balance between these two worlds of decentralized and centralized.
Now, I'd like to just who was that?
That was me, Dominic. So if I could just weigh in, I mean, from an enterprise context, and you mentioned Swift and BIC codes, and in the
IBANs too.
Yeah, and in the
securities in the hands of brokers. They've been trying to get them out of the hands of brokers for a long time. Now, there's still markets where they have them still.
Well, if you look at the clearing houses of the big internet service providers and the telecoms, they've been using technologies such as TAP for the last 50 years. And now it's being evolved to something called billing and charging evolution, which is fundamentally rooted in blockchain. In fact, we've just done a pilot with our 3 and 6 of the largest telco and ISP operators, and showed that you could create a very secure private chain, exactly like the way Graeme has suggested, except we're doing enterprise-based real-time charging across a clearing interface for these big operators globally. So the technology is there, the ability to convert to a digital coin of the currency of choice to avoid the settlement, a digital twin, if you like, is available. And we've discovered that as we move along the discovery prior to building the product, there were some things that R3 could do, R3 couldn't do. We had to work around it, but we did get the regulators and a lot of the components that are highly licensed in the telco and ISP space to comply. So,
what do you mean by clearing mechanism? Do you mean a central counterparty that's a counterparty to every trade, or do you mean something different?
So that's the thing, is in traditional tap, in the central clearing houses you trust, they behave like banks, and if one operator needs to transact with another operator for the transfer of terabytes or megabytes across a fiber connection interface or a wireless interface, they transfer that into money, and money means that the intermediary takes a cut. Billing and charging evolution takes away that intermediary. So these clearings are done effectively peer-to-peer.
Interesting. Thank you for that. It's good. It's always good to have examples from other industries. Could we just deal with Dung Trung Lu's observation here? I think we should call Bitcoin, Ethereum, etc., crypto goods or crypto assets instead of cryptocurrencies. Those assets can be traded. However, they cannot be used to pay tax, and therefore they can't be legal tender so long as no central bank allows it. What's your opinion? And I guess
that's potentially changing right now, with El Salvador announcing that Bitcoin can be may become legal tender very, very soon. So I think you could call them crypto assets. I don't have a problem with that personally. I think it's called cryptocurrencies because Bitcoin was designed to be money, and then just all these other things fell into that same bucket of cryptocurrencies. I personally use those terms interchangeably: crypto assets, cryptocurrencies. It doesn't really matter to me personally. I'm wondering if anybody else has any strong feelings about that.
Clearly not. No.
Certainly not going to die on a hill over the name of it.
Yep.
In terms of the currency, the reason that you would tend to call them private currencies is because someone other than a sovereign state's created them. I think the point that's probably worth looking at is most coins have a king or queen on them, and there's a reason for that. It's because this debate about should the merchant own the currency or should the sovereign state own the currency has been an age-old debate, one in which the merchants lost last time, which is why we have kings and queens on our coins. So it's worth looking through the history of this, because when you look at someone like Facebook, a merchant trying to create currency, if you look at Bitcoin as a decentralized or private currency, it starts to impact and starts to worry central bankers who actually only have one job, which is to enforce monetary policy. And if they lose control of their currency that they're running, US dollar, GBP, euro, then they failed. So what you tend to see now, and you're starting to see the debate raging in the US, is it starts to touch on the Patriot Act, because actually if you start touching someone's currency or their ability to control monetary policy, then you start to cause them a trouble. They'll come in hard, really hard. In London, there are still scars of the tar pits where we used to burn people alive for creating private currencies. So it's an age-old debate.
You've got two types, right? So I think it's an interesting question, because what we see is you have people who use crypto for payments and people who use crypto for investment. And there is definitely two use cases, right? So if you look at the funds, they typically hold crypto assets in the purpose of investing and treating that as an investment, as an asset. But if you look at currencies like Ripple, like DM, as you rightly pointed out, these are clearly a lot more part of payment ecosystem, potentially more than Bitcoin is. Although I would agree that sporadically you see some crypto as a legal tender. I mean, El Salvador was one, but Switzerland has been accepting cryptocurrencies as payments. But really, fundamentally speaking, you have the piece which is crypto as investment and the piece which is crypto as an actual currency as payments. And typically, it's not the same cryptos being, I would say, bucketed in both together. It's typically one or the other. They have different.
Yeah, I mean, I would definitely agree with Maxime here, right? I think the basis for, if you look at Bitcoin, in my opinion at least, is we've talked with folks, right? You look at in Hong Kong, what's happening there. It's not Bitcoin as a basis of alternative payment system, right? It's Bitcoin as a basis to given volatility, harm the retail investor, which also causes problems, right? So as a tradable asset, right? And then you look at, what happened with Ripple and with DM, right? Then, there's a view that you're right, Richard, that those then, affect monetary policy, right? And regulators come in relatively intensely on that, right? And now are looking at basis to which they say, can we learn from the digital space and what's happening, and then look at central bank digital currencies as a basis of disintermediating ourselves in some ways, right? So I definitely agree there. I think, to look at them as one kind of solid brush, I think is maybe, I would agree more with Maxime. I think the secondary basis for that is, as you think about all the infrastructure that's required, I think generally speaking, the infrastructure around payments like tokens, right, and the requirements around the extensibility of that is rather significant, right? I think, as maybe Maxime and others can say, when you look at general custodians, right, and look at what's been happening with DBS and others, right, they're not building those infrastructure bases right now to handle, like, some have, right? I'd say Zodia has done a pretty good job, but others are not building them for constant 24-hour settlement, right? They're building them as though they're operating in traditional asset classes. Whereas you think about the payments interfaces and the requirements that we as a technology provider see from folks, whether it be central banks or others looking at payments alternatives, the technological requirements and kind of the security requirements around that, by virtue of just how much activity is flowing through that system, is fundamentally different. So, we're seeing just very different, at least from a technology provider sense, very different requirements in terms of how folks would be engaged with both of those different use cases.
Mm-hmm. Stephen, since you raised infrastructure, can you help our attendee here, Sanjay Krishna, who's asked the question, is there any one place one can get a good overview of the DeFi infrastructure provider market? I'm thinking of companies like those speaking today who are offering either white label services or branded services that enable new STO-based secondary markets for asset-backed securities. Obviously, one can look at DeFi Pulse and CoinMarketCap to see what's happening there. But the infrastructure providers, where would you go?
Yeah, I mean, look, I think there's folks, consensus and what they've done is one that's enabling with MetaMask. We're seeing stuff with, technologies like Wallet Connect and others that are providing accessibility to these different spaces. Look, I think one of the interesting things, at least for us, is, Maxime was mentioning, or I can't remember, it was him. We had a large real estate fund, commercial real estate fund, come and say, look, can we look at this asset, look at the space as a basis of being able to offer direct tokens and utilize it for collateral, right? So we are seeing that. I mean, even in bank conversations, I guess where I would vary a little bit differently is within the innovation departments and within, folks that are engaging in the space and capital markets, the capital markets use case, right, where they're starting to explore. There are questions about what does it mean, what's the potential for it to disintermediate what we're doing, how can we leverage that, the settlement models and the protocols and what we're doing in the traditional space. I don't think they're going to file towards using an open decentralized protocol, but I think there's a lot of intrigue, I think, in the early space in terms of how the technology application itself can be used. And I think that's where it becomes pretty interesting, not necessarily going all the way towards, full and open DeFi model, but rather looking at the technology application itself and saying, what can we learn from that? And then how do we then drive that from a technology perspective, given the regulatory hurdles that we have to enable something interesting to happen?
Now, we had this is a question I'm burning to ask, actually, which goes to the heart of what we're talking about today from one of our attendees here, which is, in your opinion, what are the main business opportunities for custodian banks at the early stages of blockchain? Is it key management, identification, by which I assume means the KYC side, digital wallet management? And there are all these things which are often talked about for CSDs as well. They could be transaction validators, they could run these permission networks, they could, as our attendee suggests, run KYC AML processes, they could provide digital identity, for that matter. They could orchestrate provision of services from independent providers, i.e. putting together a portfolio of services to provide what a global custodian bank does today, maybe do it on an auction basis once a day even, or once a week or once a year or whatever. They could facilitate interoperability. There are lots of things which custodians could do. But what do you think are the main opportunities? Maxime, you're backed by 2 custodians. I know that your interest at this point is cryptocurrencies, but to what extent are the banks that back Zodia looking forward to new services that could be provided? What would be your answer to our attendee?
If you think about purely custodian of digital assets, right, the role of custodian is slightly different. The purpose may be the same. So if you're familiar with the UK CAS rule, which is client asset rules in the UK, the 17F5 in the US, which is safekeeping clients' assets. That's essentially what it is. It's the same principle. The way you do it is fundamentally different, right? Public-private key pair, blockchain, nobody really knows anything about it. And certainly traditional banks had never heard of that, never had an infrastructure like that in the past couple of years, right? I think they're now getting into this. So what it brings is you essentially, as a custodian, you have a very different risk to deal with. You have essentially the cyber risk, and then you have cyber and technology, and then you have the compliance and financial crime risk, which, to be fair, in traditional custody doesn't exist. What's interesting as well is what we've discovered is a lot of our clients expect the custodian to alert them on the risk of the underlying, be the underlying blockchain, the underlying coin, and there is complete due diligence that they expect custodian to perform, which you wouldn't do that. Right? When you buy a Tesla stock, you don't ask your custodian whether there is real stock, whether Tesla is a good company, whether Swift is actually a genuine system, etc. It's pretty obvious, right? So I think from a custody perspective, there's a lot of activities that custodians will have to take on because they are absolutely centered to clients' safekeeping, but also the activity around trading, exchanging, and so forth. If you put the sort of the hat on the traditional banks, there's plenty of services that they need to offer on the back of digital assets, right? So we're getting significant interest from prime desks who want to use their collateral, provide leverage. Custodians looking at integrating it in a global custody model, centralized or consolidated reporting, offering fund administration services, fund accounting, advisory around new types of products. So there is really a lot on the traditional side as well that banks could use just with a simple crypto custodian, because that enables them to, I would say, provide a lot more financial services around just another class of assets, really. People should think about, digital asset as just an emerging market, really. A little bit different, market access is different, regulatory is different, but ultimately it's just a different class of assets, which is a bit newer.
Yeah, I mean, I would say what I think is interesting, right, is that for custodians in the space today, you're driven as a technology firm in a lot of ways, right? I think to Maxime's point, the most fundamental risk in digital asset custody is a cybersecurity risk. It's in essence, everything that you do, and as you think about the natively digital space, there are repercussions and there's no recourse for the loss of assets or the compromise of the private key infrastructure. That in itself is a cybersecurity issue. And if you look at the early custodians in the space, most of them were built around from a technology basis, right? And so I think that the expectations, as Maxime was saying, that you're educating folks on a technology basis first, and then you're seen as basically, gatekeepers of knowledge as far as how folks should be operating in the space and what's interesting, what new blockchain protocols should they be looking at, is something that we see happening quite often. And so I think that that becomes like very much the interesting paradigm, as at least from a technology basis, we work with customers to kind of implement this infrastructure, is that there's a fundamental shift in the idea that there is recourse if you go into a CSD, right, or use CSDs, or as a large global custodian, you're holding paper that in essence you can in some ways have recourse against. And changing that model, right? Because generally from a cybersecurity perspective, that's allocated and siloed in the bank. And now in the digital asset space, that becomes the forefront for how people need to engage, right? And so the most important teams as you implement infrastructure from a digital perspective, banks, custodians like, Zodia, et cetera, are the cybersecurity and OPSEC teams. And they control, in essence, the basis by which the product itself will go to market. So I think that's a fundamental difference between what we're seeing, at least from a technology provider perspective.
It's worth me jumping in here Dominic to point out that if you look at this from a business opportunity of a custodian bank, first of all, it's a custodian bank. It's got the word bank in it, which means it's already regulated, it's already allowed to use the word bank, and there's always a role for a trusted party in a transaction. There's always going to be a role. So from that perspective, there is good news in this. But actually, from a main business opportunity, if you broadly look at what's going on here, it is early days. You are seeing, though, the creation of what we would describe as an internet of value, where we've spent the last 20 years rolling out an internet of information, and we've broadly worked our way through that wave of the last 2 decades. The next 2 decades is around what we'd call the internet of value. And yes, it will impact those inside the custodian banks. And the main business opportunity comes in 2 ways. On the bottom line, you're already starting to see those custodian banks realize that just as they got efficiencies from the rollout of email and web servers, you're going to see the rollout of improvements in terms of payment processing and settlement, because you can start to do payments on the same fabric as you're settling the securities the other way. But I think if you look at it from a top line, it's much more exciting. You alluded to, or you raised the McKinsey report that showed that there's $7 trillion worth of private equities and debt, the majority of which is not held in those custodian banks. And that market is almost certainly going to end up dematerialized as digital securities, along with a huge wave of other assets that are yet to be tokenized or securitized, because we're moving the price of how we do securitization. So actually, that market is probably twice as big, 3 times as big, and that changeover is open to those custodian banks who right now have a 2-year lead on anybody that joins this space, because they've already got a regulatory space in the space. And to give you a couple of examples of where our clients are seeing this over and over again on the top line, they are seeing financial services coming out of financial services and going out into the other sectors. Just as Yakeen points out, telcos have worked out that they're actually running a payments network that could challenge the bank's transaction services. And actually, they've already got a billing circuit to most corporates and most retail clients. So why can't they run a payment space? So that embedded finance thematic works towards the custodian banks. If you sit still, you'll get your lunch eaten, but you can eat other people's lunch. And that probably takes you as a custodian bank in your model. The neighboring market is asset servicing, where today, the majority of those securities held by custodian banks are hold to term assets, where they cannot secondary trade them. They cannot create coupons beyond the primary investor. And actually what we are seeing with the rise of DeFi and the rise of the crypto infrastructure is you've now got the ability to do a lot more for your clients than you were before.
Using smart contracts, Richard.
That's right.
That's right. If I could just chime in, you find custodians in multiple forms. I think you've covered custodians in the form of banks, but the telcos are equally the licensed custodians. And one of the things they share in common is they have a very well understood, socially acceptable KYC model. Secondly, they have something that we need in the securities of decentralization, which is hardware secure modules. So if you take the hardware secure module as a service and start to apply it to the securities market, you'll find that custodian banks, the telecommunications providers, anyone who has been regulated and authorized to offer edge or centralized based hardware as an oracle or as a notary suddenly starts to come to play. And there are pieces of their technology that will fit into our puzzle.
Thanks, Yakeen. Now, Maxime, you said something which was very interesting, and we're into our last sort of 10 minutes now, so we don't have long to go. But Lee Sager, member of our audience, has brought this up, and the point you made, Maxime, is you're now being asked by clients to check the security of the substrate, if you like. You're being asked to check whether Ethereum is more risky than Solar or vice versa, in a way you were never asked about Swift or any other standard network. Lee Sager's question is, do you think the technology is currently secure enough for a risk-averse bank? So, Maxime, how are you answering that question from the clients? Is the technology safe enough?
So, well, technology is a big word, right? So if you were to peel the onion a little bit, right? So you have a layer which is, you're right, the technology, and typically what we look at is, I mean, again, this is what we do, but others have a different view potentially. But node distribution, right? Who runs the node? What is the likelihood of potential attacks? Do you have enough nodes? Then we look at aspects around the liquidity, where the currencies are being traded. Is there enough liquidity? If our client wants to sell, if there's a market event, is the pool deep enough? You look at obviously the financial crime, the compliance aspect on who runs the network, what is the network being known for, used for, etc. So there's a variety of aspects that we tend to do in order to make sure that it's somewhat a safe place for our clients to operate. I would say it's not, by the way, it's not just a network. We also do that with counterparties, right? So when we deal with counterparties, if you look at traditional finance, I think Richard made a point. Most traditional finance have the name bank to it. They're all regulated. Somebody's done some due diligence on them. The crypto market, you don't really have any of that. Anybody can come on and be a custodian, be a wallet provider, be a participant. So there is really a complete due diligence over the ecosystem that is required. Making sure that you connect to the right people, that you offer a safe environment. Again, we deal with institutional investors, so for us it's extremely critical that we don't sleep up. There is absolutely no margin for any errors on the cyber side, as Stephen mentioned, on the compliance side, the financial crime side, and even on the technology. Because to be fair, although it's not the role of a custodian to look at underlying technology, asset safekeeping is our primary responsibility. We have fiduciary responsibility around that, and we believe that it's the technology review is actually part of it.
Now, Maxime, I know you've got to go promptly at 3 o'clock, and I'd like to ask you one question before you go. And it's the same question I'll put to the other panelists. It's this: that what is the state of maturity of the let's call it the crypto currency or crypto asset, digital asset custody market? When it first began, there were these very obvious conflicts of interest. It was dominated by these exchanges. They provided the issuance, they provided the trading, they also provided the settlement and custody. There were obvious conflicts of interest built into that. They were using omnibus accounts, they were mutualizing risk. It was like all the things which, as Richard has described earlier, we worked very hard to drive out of the securities markets in the past, were all reproduced in the early days of cryptocurrency. We're now starting to see mergers taking place in the cryptocurrency space. We've got PayPal buying Curve, we've got Galaxy buying BitGo, we've got guys like you setting up the services you're providing. So clearly custody is in this new market is evolving. It is becoming more mature. And would you expect, as you look forward, I don't know how far you want to look forward, 5, 7, 10 years, are we going to look at a kind of oligopoly developing? Are we going to end up with, as we are in the securities markets today, with 80% of the assets with 4 or 5 banks?
I wouldn't go as far as 5 years. But what I do expect, and this is something we're seeing now, is I personally think that you're going to have an unregulated portion of the market that's going to be a lot more innovative, a lot less regulated, probably a lot more creative as well. And then you have a traditional side of the market, which will be regulated and get much closer to traditional finance in many ways, with the same type of participants, plus minus a few. I mean, we didn't talk about the rule of CSDs, but there is definitely a question mark around their role in the future. But I certainly do think that you'll have two paths: an unregulated one and a lot more regulated one. I think there'll be probably space for everybody. On the regulated side of things, honestly, I don't know who is going to be in that market. While it's, I think, relatively open at the moment, I think barriers are being built. The barrier to entry when it comes to regulation, when it comes to network. I mean, what Fireblocks is building in the network of participants is very difficult to recreate in the end. So you're starting to see that building up. So I think there is space for people to enter. I'm not too sure at what stage you'll have a tipping point where it's going to be probably too late to actually enter the game. But yeah, so that would be my bet. Two sort of, an unregulated path, a very regulated path, and within that regulated path, I think we'll see some changes on who the participants are going to be compared to traditional finance world as of today.
Yeah, I mean, I think I wouldn't disagree too much here. I mean, I think the question becomes whether the folks in the regulated path are would be enabled to, drive at what are the models, and I will use the natively digital space that exists and how people interact today, right? And I'll give you an example. There are banks that have launched offerings that have 9 a.m. to 6 p.m. settlement times and don't operate on weekends, right? That is a fundamentally different view of how the market works. And given the fragmentation of liquidity and the power that some of the large market makers and exchanges still have in the space that are, able to engage on a regulated basis, but are used to this model of working in a 24/7, ecosystem and the involvement of retail and retail sentiment, I just don't see the ability to just operate as is, right? And so I think from our perspective, right, as a technology provider, we are looking to say, okay, as these traditional institutions get into the space, are we able to take the learnings that we're seeing from the natively digital space and solidify them and basically make them institutional grade such that the banks that are regulated are able to use them and then are able to build the infrastructure around them operationally that makes sense and appease the regulator. I do think that there will be an unregulated side of the market, as Maxime says, and I think a lot of innovation happens there, right? DeFi is a principal example of a non-regulated market where innovation is occurring, and that I think that innovation and that technology basis will be hardened in a lot of ways and then brought into the regulated space and the institutional space, right? So I don't think that they can't coexist together, but I do think that the technology basis that the regulated folks are going to have to leverage in some ways, and then the models that which they think about them, right, and it will be impacted by what's already happening in the non-regulated space, right, or in the natively digital space that exists today.
Mm-hmm.
I'll jump in with kind of one comment there in terms of the consolidation of players in the space. So we actually had a similar webinar to this about 2 weeks ago. There's a custodian from the UK and Hong Kong, one in mainland Europe and one in Singapore, not Fireblocks, sadly. But and we were talking about the BitGo acquisition. So BitGo, a custodian acquired by Galaxy for $1.2 billion. And I said, do you think we'll see more consolidation in space? Every single one of them said yes. They all said there's too many players in the space. We'll probably, I wouldn't use the term oligopoly, but that's generally how financial markets seem to shape out. There's, let's call it 5 to 10 to 20 very big players, and then there's everybody else. And so all of them agreed that there would probably be some consolidation. And now, of course, I don't know if that was a pitch from them trying to get acquired by a bank, but I think that's what we're going to start seeing as well, is we'll start to see some consolidation around the largest players with the best in class operations that are the most highly regulated, especially in the security space.
Can I perhaps just we must stop in a minute, but I'd like to linger on that retail wholesale point. Giles Elliott has asked an interesting question here, which is, what is your view on NFTs, non-fungible tokens? Do you see demand for non-fungible tokens in the retail community? And I'm wondering if in the long term there is an opportunity here for custodians to actually service or maybe CSDs to service retail investors directly, rather than going through these asset manager, pension fund intermediaries. Is the long-term future here for direct interaction almost between issuers and retail investors? That's kind of what we see happening initially in crypto, and now we see in DeFi. It's a non-intermediated market, if you like. Yakeen, I'm sure you've been thinking about that, and your experience in other sectors maybe gives us some special insight on that.
My initial position on NFTs are that if they come from a limited set, for example, then they could be considered as securities fundamentally. And, how is test aside? There are some very specific examples of where artists specifically have created elements of value that can be considered to be securities. So for the public eye, how is that viewed by the regulators? Perhaps it should be viewed as a security token. Perhaps it should be viewed as something that can be exchanged, albeit unique in its nature. I think the NFT market is too young to be made a call on just yet. But it definitely is, much like DeFi, it is one of those things that is innovative and it's booming. we're going to see multiple incarnations of it as it evolves.
And retail, custodian banks servicing retail investors?
I mean, look, I think it's a question of the underlying technology, right? So, I mean, I think the basis is, operationally, if you think about like the staffing models and the requirements from a technology service basis today, it's not necessarily built for that, right? So, again, KYC implications, identity implications, servicing implications, throughput implications, like it's just not built for that. But I do think there's evolution in a way that basically the technology around, both the custody level and the digitization of those assets would allow, right? And the ability to create different private key models, the ability to create different network infrastructure, network structured models. So, can you connect directly and seamlessly to the hardware components that a retail consumer might have, right? Such that you can enable a secure mechanism by which they're able to store assets with you as a custodian. So, I mean, I think there's a lot of thought going there. I think it's a little bit away, from happening, but I do think the technology is there to potentially support that.
Okay, we've run 5 minutes over, so let's wrap it up. But perhaps wrap it up with one last question, which occurs to me listening to everything I've heard this afternoon, which is that these worlds are very different. The question is, are we engaged in some sort of Hegelian dialogue here in which there's a thesis and a counter thesis and a new synthesis emerges from it? Or must one side of this win? Must the true believers in blockchain win, or the pragmatists win? I can see Richard's burning to ask that question, but I won't let him go with it first. What do you think, Graeme? Are we heading towards a new synthesis, or must one side win?
I think what we'll see is generally what happens with any new technology, and it's sort of somewhere in the middle. All of the anarchists and free thinkers thought the internet would bring about amazing prosperity and free speech, and that happened for a brief period of time, and it won in some respects, and then pretty much anyone, if they lose their Twitter account, has trouble talking to anybody else. Yeah. So I think it's going to be somewhere in the middle. I would say I'm probably more on the end of the technology, kind of cypherpunk mentality side of things. I hope that a lot of these technologies are allowed to flourish with the minimal amount of regulation that's possible that still allows consumers to be relatively safe in these markets. And so I think we're going to see the full spectrum. We'll see some regulators that allow people to operate in sandboxes and have as many clients as they want. We'll see some that only allow accredited investors to engage with a lot of these products. We'll see some that have a tight grip on exactly who's allowed to participate and how, and they'll need to keep their CSD in place. What I'm trying to say is we'll see everything. I don't know which one will win. I'm not smart enough to be able to predict that, but I think we'll see kind of every single model under the sun tried in every jurisdiction, in every single market, and then we'll start to see where the market converges over time.
Now, Richard, you used the phrase Internet of Value versus Internet of Information, and as Graeme has just pointed out, the Internet of Information didn't fulfill its promise. The Internet is abused by some of the worst governments in the world, and even by some of the best governments in the world, to shut people up. The compromise has been somewhat unsatisfactory in the Internet of Information. Are we going to end up with an unsatisfactory compromise in the Internet of Value as well?
I think the history shows that we always see an over-exuberant use of the technology. The advent of radio and television raised nationalism in Europe, and as we've just watched, the rise of the Internet of Information has caused some challenges to some of our democratic processes. But leaving those aside, back to the subject of how this plays into the securities market. I think if you watch what's going on with the white heat of innovation going on in crypto, with what is a very conservative space now in the regulated area, those two are converging. There is no doubt in anybody's mind now. And in terms of, do we think one will win over the other? To use the literary phrase of the last line of Animal Farm, which is the creatures look to man to pig and pig to man and back again and could not see the difference. It doesn't matter whether you started out as a pig or a man, they're going to end up as the same thing, because the regulation will cloak both sides and slowly but surely grip them. The reason we say that is because if you look at our space and the customers we're working with, regulation is always the start of the conversation, very much in line with the business opportunity. And they know that both go in line. There are many people entering this market that think that they can avoid the regulation and see a huge profit margin. But as soon as they apply the regulation, they realize that actually there is no margin to be had because the regulation arbs them out. So I think from our perspective, we work with clients very closely to get them started on this journey. We've obviously got capability to help them. But I think where we see the major business opportunities in the private securities market, where the investment's already been done in the public sector. And we think that actually these two spaces are merging, converging, and you won't see the difference over 10 or 15 years.
Yeah, I know we're at time. I mean, I think one thing to think about here is the ability for the regulators to continue to keep pace with the change, with the evolution in technology, right? Like, and even from a regulated basis, right? You'd say that banks are probably, as you mentioned, 2 years behind on the basis, and regulation as a basis of activity in a general sense is also behind, right? So, I think there are people that are always willing to test the boundaries. I mean, you can look at Binance as a basis of listing a token without really a regulatory basis, and doing so and testing the basis by which it lies. I would argue that if they listed that token on a DeFi protocol, it would have taken a little bit longer of a time for the regulator to catch up with the basis of which that was sitting there and how it was being used as a collateral basis, right? And people they're going to be these edge cases that get pushed, right, and by virtue of opaqueness and where the regulatory or people's interpretation of the regulation, which is generally which is everything, right? And so I think people are going to the folks that are the enthusiasts, right, are going to continue to push the gamut forward in some interesting ways. And the folks that are pragmatists are going to look at the technology basis and bring it back and see how they can work within their interpretation of the regulation as it stands. And I think that's what makes this entire space very interesting to me, is that, both the approaches and both the sides doing so are actually in some ways pulling and pushing off of each other, I think, and pushing the space forward. So, that may be a middle of the road view, but I think it's probably, in my view, how it'll shake out.
Mm-hmm. I think you were describing a Hegelian dialogue there, Stephen. I think you and I can agree on that. That's great. Perhaps a very last word from you, Yakeen. Perhaps you can give us a flavour from outside the financial services industry as to how this dialogue between the revolutionaries and the pragmatists is going to unfold.
I think that it's just going to continue as an eternal battle. My position is that there's some hybrid ground to be found. There's always going to be the outliers who will keep cutting through regulation to create new innovative ideas. I love the cyberpunk model from Graeme. That's exactly where we see that bleeding edge of technology where we feel the hurt, we put ourselves in uncomfortable positions, we challenge the regulations, and then the regulation changes to adapt and consume us, and then we move on to the next thing. I also think that it's going to be horses for courses. I think there's going to be playbooks and use cases and strategies and scenarios where one will defeat the other. In specific examples, we can see that NFTs, if they fulfill a reach where they are like playing cards and Pokemon dragons, we can see that would work through, in a very different way to if I were to buy Tesla stock in an unregulated fashion. So my thinking is that this is going to be not well drawn. We're never going to draw a line under this. And when we do, there's going to be the next thing. It's going to just be a wave of evolution.
Thank you, Yakeen. With that, I think we'd better stop. I can see we could talk about this for many hours to come, but we must stop there. I'd like to thank our panelists, Stephen Richardson from Fireblocks, Richard Crook from Lab 577, Yakeen Prabdial from Fifth Nine, Maxime de Guillebon, who's left already, from Zodia, and Graeme Moore from Polymath. And thank you also to you, our audience, for your interest and especially your questions and comments. At Future of Finance, our next event is Thursday next week, 17th of June, at our usual time of 1400 hours London time. And we're returning to a business which is somewhat demoralized by the collapse of one innovative force, but still in need of a technological revolution. That's trade finance. And I hope that lots of you can join us then. Please do. But for now, it's goodbye from the